Good morning, good evening, everyone joining us for the inaugural edition of Around the Valuation World International. We're pleased to extend the North American version of this news program to our members around the globe. AVW was launched several years ago as an opportunity for members of the NACVA to reach into the global business valuation and financial forensics profession, initially based in North America, with news content, updates to theory, methods, approaches, case law, specific industry issues. Since so much is changing in the profession of business valuation, this show was conceived to bring all of the current updates to you on a monthly basis through the live online webcasts. Around the Valuation World International is a 2-hour program once a month, and the AVW International version will complement that. It is a program that will be programmed and hosted by our Global Association of Certified Valuators and Analysts, GACVA, our advisory council. Two of the advisory council members joining us this morning are Pratik Shah with our chapter in India and Andrew Newman with our chapter in Canada. We will be joined in subsequent versions of AVW International by Wolfgang Nist with our chapter in Europe. We have a special guest today, Professor Pablo Fernandez, and we'll get to him in just a moment. He'll be sharing some technical content to some surveys he's published, and he will present some information, further being interviewed after Q&A from Andrew and Pratik. As Professor Fernandez goes through his presentation, if you have questions you'd like to pose to him, please use the Q&A or the chat box, and we'll do our best to field your questions to him during the Q&A portion of today's broadcast. There's also an Around the Valuation World US just a little bit later this morning, so you can attend another show for 2 hours of CPE. And for those of you who are joining the international version, you will receive complimentary CPE, where the AVW program is generally a subscription program. So you'll receive 1 free hour of CPE for the international show today. And later, as you join us in subsequent issues, we hope that you will subscribe to the show, where you'll get continuing education as well as access to the archives as they're recorded and made available on demand online. A quick run through for those of you. Chinda, is my screen sharing, or do I need to do that yet?
Yeah, you can share your screen.
Okay.
While he's doing that, I'm going to do the first poll question.
So the first poll question is up, which means you'll need to respond to this and all poll questions in order to receive your free hour of CPE. We'll give you a brief reminder that they're up, so you won't miss them. But about 7 to 10 business days after today's broadcast, you will be able to log into your portal on NACVA or GACVA and access your CPE certificate. So if you go to the Global Association of Certified Valuators and Analysts website, globalcva.com, if you are a member, you can click log in. If you are not a member, you'll need to create a guest account by going to the association and there's not a join link here, but we can get one. There will be a join link where you can join as a guest. And so we'll certainly need to add that. It is available through the nacva.com website under Association, Become a Member. You can join as a guest. So if you are not a member, you can go to nacva.com under Association, Become a Member, and select Guest. There's no cost to be a guest, but you will need to have a guest account to access the free CPE certificate. that you can earn today from ABW International if you're not a member. If you are a member, you can log in with your email and password. Once you do, you'll click My Account. You can do it from here or from here. Click My Account. Will open up to your portal for your member profile. And as you can see here, I have added my photo for my profile. I've also gone in and added some detail, my company address, my website, a brief bio. We encourage all of our members to do that. From our headquarters office, we promote the member and credential designee directory to users of business valuation, judges, attorneys, business owners, the courts, so that they can find experts through our directory and a number of search criteria. So you could possibly be receiving referrals from our directory. So we encourage you to, if you haven't already, go onto your portal, log in, and update your profile. Now, to access Around the Valuation World each month as a member, once you're logged in, on the left-hand side, you will see here the link for Around the Valuation World. And every month, you will be able to click to view the webcast, as well as the materials that are available. And this portal will be used for both ABW US and ABW International. So in one quick place in your member portal, you'll have access to the ABW resources, but also these others. You'll be able to view and print your CPE certificates. You can see I've got a few here from other events. I can print certificates from prior training programs. You can access free benefits through the Econassist subscription, which gives you data, publications, all kinds of great resources that you can use as part of your membership. For any webinars or courses or programs you purchase, you can access those materials through the online campus. You can learn about upcoming events, search our mentor directory, access exclusive member benefits, these publications, and all the other resources along the left-hand side are available to our members as part of their annual membership with the associations. If you haven't explored the member portal, we encourage you to do so. Specifically to our GACVA chapter, which is the website where we feature activity from our chapters. You are able to learn about the association and the criteria for our credentials, the Certified Valuation Analyst, the Master Analyst in Financial Forensics. If you're wanting to apply for those credentials, you can do so here as well. We offer quite a bit of training, actually a lot of training, in various specialized areas. And one of the objectives with our GACVA Advisory Council will be to address continuing education courses. So there will be specific international content developed, taught through leadership from our GACVA Council. We'll keep you up to date through these coming months as to the programs we're launching and building. You can also access the exclusive member benefits. Looks like these are actually repeated from the member portal login, but in order to access them, you will need to log in as a member. These are exclusive member benefits, and you can use the login portal here. Our chapters include Africa, India, Canada, Europe, the Mediterranean, North America, Southeast Asia, and Taiwan. We're pleased to report across all of our chapters that we've got very active CVA credentialing programs being scheduled or hosted this year, in addition to some conference events and virtual conferences as well. Our chapter in Africa and India will be hosting CVA training in the coming months. So you can certainly learn more about these chapters by clicking on their website. The logos, rather, will take you directly to their websites where you can see their news and training and events are all featured for each of the chapters. We're pleased to be working with Andrew Newman, who's one of the co-hosts for today, to launching or actually rebooting our chapter in Canada. Our chapter in Europe is hosting a conference this March, a virtual conference that is featured here in this first banner on the homepage. If you're interested in learning more about the EACVA conference, it will be held in March. It's going to be online. You can certainly click this link or their logo here to go directly to their chapter and learning about their events. Similarly, our chapter in the Mediterranean, Southeast Asia, and Taiwan are offering CVA training throughout the coming year. So if you're interested in learning about the CVA or applying for it through our chapters, you can reach to them directly. If you are not affiliated in one of the countries or territories that are represented by our chapters, you can certainly contact our headquarters office with the North American chapter of GACVA, and our member client services staff can work with you to earn the credential and get you trained as well. The materials, the exam, all the resources are available virtually online, so we can support you to achieving your CVA wherever you are around the globe. And so we're very pleased, as I mentioned in the beginning of the broadcast, is to launch this ABW International with partnership of our Global Advisory Council to extend additional training and resources and knowledge beyond that is published through the NACVA in the US. We really are looking forward to focusing on international content with international experts, as today we're launching with Professor Fernandez. In the coming months, we will have Carla Nunez with the Duff and Phelps, Matthias Meitner. He is a valuation analyst in Germany, as well as Anna Maria Ciobanu. She is a leading valuation analyst with KPMG International. And on these programs, we will focus on international topics and issues. And we'll get started with today's program and our guest, Professor Fernandez. I'll give a brief introduction of him, and then we will get started with some technical knowledge. Let me just get this bio, one moment. How are you doing, Professor Fernandez? Can unmute your microphone for us.
How are you doing, Brian? Very well.
Very good, thank you. Pleasure, thank you for joining us.
It's a pleasure.
All right, let me just pull up your bio here. Professor Fernandez has a PhD in business economics, finance from Harvard University, an MBA from IESE Business School, University of Navarra, Barcelona, Spain, and an industrial engineering, School of San Sebastian, University of Navarra. He has published a number of books, 2 in English, 16 in Spanish, and more than 150 articles in business papers and specialized reviews and journals around the world. In addition to over 265 working papers related to business valuation. On today's segment, he will be giving us a look into, I want to switch agenda to his title slide. Valuation, common sense, and common errors, and normalized risk-free rates. Again, thank you, Professor Fernandez, for joining us, and we'll turn this portion of the program over to you.
Thank you very much, Brian. Well, in this session, this session is part of a class that I normally teach in my valuation courses at ES Business School. Well, courses related to valuation, not for normal executives. And I would like to focus on three things about using the capital asset pricing model, and that I am not going to tell that you don't have to use the capital asset pricing model, but that we have to think a little what do we do. I start with an example of a European Electricity Regulatory Commission that what they try is always to establish what is the WACC of electricity transmission, electricity production, and they start normally calculating the beta of the activity. And then what they do is they calculate the beta of all traded European companies using 2 years of weekly data. Why 2 years and not 5 and not 1? And why weekly data and not daily data or monthly data or bi-weekly data? We don't know. Is what they say, and they don't know. They don't say why. And the market index chosen was the Dow Jones stocks total market index. Why this index and not other? They don't say either. This is common in most of the valuations that we can see around the world. Then they calculate the betas and they see, as usual, a big dispersion. The betas goes from minus 0.24 to 1.16. And they say that there are odd betas. They say that odd betas are negative, that are a little odd, and higher than 1. I don't know why higher than 1 is an odd beta, but is what they say. And then they see all this dispersion and they say, what do we do with that? Usual answer. We maintain all and we calculate the average. The average is 0.47. And what is the average? Is something, nothing? What is the average of a thing that has a lot of it is of a sample that has big dispersion, as you can see, and I tend to say that is nothing, but is what many people does. Because why nothing? Because of the extremely big the dispersion. Next slide, please. And then, as they want to calculate the WACC, they also want to calculate what is the debt to equity ratio of European companies. And they calculate the debt to equity ratio of every company, and it goes between 0.66 and minus 0.04. What do they do? Again, they calculate the average, and well, with those things they calculate the levered beta and all this. They unlever, relever, and they say that the levered beta is this number there, 0.47 something, with 9 figures, no? After the decimal point. This is something that they have never seen. Normally people tend to use two figures, but to use 9 figures is really a record, no? And this is very common in all valuations. That we say we are going to calculate market betas, and what are market betas? Normally is big dispersion. We calculate the average or the medium or the average excluding the maximum and the minimum, something like that, and we feel comfortable, and people tend to feel more comfortable using more decimal figures, no? Next slide, please. The question is that the capital asset pricing model that is very used is an absurd model. Why? Well, basically because the capital asset pricing model is about expected returns, no? is not to tell us what is the required return to investments, it's about calculating expected returns. And there is a very easy question that I have asked many of my colleagues that use also the capital asset pricing model, asking them, if you find a formula that that calculates quite well expected returns, would you publish it before or after becoming billionaire? No? It's and the thing is that, well, of course, nobody would calculate a formula like that, and perhaps when they are near to death, perhaps they calculate if they don't have children. No? If they have children, I think that they are obliged, morally obliged, to give the formula to their children. But as we will see in next slide, the capital asset pricing model is an absurd model because the assumptions and predictions have nothing to do with our world. The main assumptions of the capital asset pricing model that many times we tend to go through without looking much at it, well, there are more assumptions, but the three biggest assumptions is homogeneous expectations. It means that all investors, when I mean all investors, I mean all, have the same the same expectation, same expected return for every company in the world, the same expected volatility, and the same expected correlation for every security with any other security of the world. That is why it comes this word of representative investors. Well, if all investors have the same expectation about everything, then you can say that the market is like a fat investor, no? Because all investors have the same expectations and they think the same about return, volatility, and correlations of every security. Next assumption is that investors only care about expected return and volatility. The expected return is good, volatility is bad, and identifies that risk is the volatility. No? But the question I find is that I have relationships with several investors. Some of them are millionaires, and of course the ones that are millionaires, they don't appear in the press. No? And normally, a common characteristic of all those investors is that they like volatility. I personally like volatility also. What I don't like is that I buy a share and the company disappears. This I don't like. But volatility, that prices go up and down, I prefer that they go up and down more than a very boring market, that prices are very stable and that the volatility is very big. No? And the world that the capital asset pricing model describes is this world. No? Our world is like that. Well, I think it is not. No, it is not, because investors have different expectations. With homogeneous expectations, how do you explain volumes in the market? For having a share bought by an investor and sold by another investor, normally they should have some different expectation. No? One of the investors should have an expectations of high return, the one that buys, and the other not clear expectation, or expectation that the share is going to do badly, or, well, this thing of the homogeneous expectations is something that common sense doesn't support. No? And the other thing is that the bad thing, the risk, is the volatility. No? The risk is the risk of that the company disappears and you don't have any more a share or a bond or something like that. No? And the predictions of the capital asset pricing model is that all investors will always have a portfolio combining the risk-free asset with the market portfolio, no? The portfolio of all risky assets. and all agree on the expected market risk premium, well, because all think the same about everything in the future, and on the beta. No? And as they agree, the expected market return should be equal to also to the required market return. That is the market return that we have to use in valuation. No? This thing is also important, that for valuation we have to use the required market return, no? The market return and the market return premium that we require for the market in a moment, and not the expected. No? I may have an expected return of 70% because I am very optimistic about a company, about the cash flows, but I would my required return has not to be 70%. No, it normally would be lower because I don't see so much risk on this share. No, and equally, if I have to value a company and I have expected return that is negative, that I think that the price will go down. If I value the company, my required market return is not going to be negative. Will be are completely different things. No, and important thing is that with homogeneous expectations and without disagreement about the value of any security, trading volume of financial markets would be very small. No, it's very. How do you explain the huge volumes of financial markets? Well, because expectations are not homogeneous. No? Next slide, please. Well, this is just an anecdote from Merton Miller that when he was getting the Nobel Prize with Sharp and Markowitz, the guys, physicists and chemists, were there, and they asked them that which one was the basic unit of the finance research, and they said that it is the expected rate of return. I don't agree with that. I have never talked to expected. I have been teaching for 32 years, and I have never thought of how calculating the expected rate of return because I don't know how to calculate it. No, and they admitted that was not actually observable, and the other scientists were laughing at them. Well, because if this is the main unit of the research, what you know is that if somebody finds how to calculate the expected rate of return, well, they are not going to publish. No. Next slide, please. Well, the calculated betas have a lot of problems. The first problem is that the market beta that many people talk about does not exist. No, different investors will see companies with different risk, and normally they will put different betas to the company. You say, well, but we can calculate. Well, if you calculate, the calculated betas depend very much on the stock market that you use as the index, the historical period you take, 5 years, 3 years, the returns, if you use monthly, yearly, daily returns to calculate them. And they change very much for one day to the next. No? If you calculate a beta yesterday or you calculate today with monthly data, the results are very different. We will see. Next slide, please. Here are the calculated betas with 5 years of monthly data in the month of December 2001 for Coca-Cola, AT&T, and Merck. No? From day 1 to day 31 of December. How you calculate that? Well, the returns on day 5, the monthly return goes from day 5 to day 5 of the next month, and so on. On day 31st, that is the ones that typically are used, They go from the last day of one month to the last day of the month of the other. And here you see the big change between one day and the next. No? This is only 1 month, from the 1st to the 31st of December. The good news about that is that if somebody asks you which company has the highest calculated beta, you can say anyone, and you are right in some of the day, in some day, no? And also the opposite, which one has the smallest, you can say the company you want, and in some day you are right. But the thing is, what are what is the value of calculated betas? Well, according to this figure, I would say nothing. Next slide. This is another experiment that is putting you in one date. Here the date is March 31st, 2014. We calculated the betas of 1,300 companies, American companies. But the thing is that for this date we calculated many different betas, no? Betas using 2 years, 3 years, 4 years, 5 years of historical data, also using monthly, weekly, daily returns, using different market indexes, and here is the summary of the 147 betas for Coca-Cola. This is the beta for the same day, and for PepsiCo, just to give you an example. And on average, the summary of the betas of all the companies that is below, the average maximum beta minus minimum beta calculated for the single day is bigger than 1, no? It's 1.17. So you calculate a beta with, it doesn't matter how many decimal figures. What does it mean? Well, that you have calculated one number of these 147, that you can do another calculation that gives you a much bigger value or a much smaller value. No? Next slide, please. If you go to webs, also you do the exercise of going to different webs to see which is the beta that they propose. You see also a big dispersion. No? In this sample here of different webs, the dispersion is, as you see, for Coke, betas went from 0.3 to 0.8, for Walt Disney from 0.7 to 1.4, and for Walmart from 0.1 to 0.7. So you can justify the beta that you want. Next slide, please. The thing is that valuation, that most of you have done a lot of valuation, discounted cash flow valuation, I mean, is in many times a kind of schizophrenic approach. No? Valuation is only about expected cash flows and about required return, well, discount rate. And then about expected cash flow, most of the people, well, they think that different evaluators may have different expectations. No? One may have more optimistic expected cash flows. The other one can be a little less optimistic, and is something normally that is admitted. No? But when we go to the discount rate, about the required return, many people tend to be a kind of dictator, no? That say, no, the right number for discounted cash flow is this one. So this is the schizophrenic approach, no? That is like kind of to be Democrat and admit different opinions about expected cash flows, but at the same time admit that the required return, the discounting rate, should be the same for everybody because it's scientific or I don't know what. But that all the science, I remember you, comes from the capital asset pricing model that we have seen before. That is everything but is not science and is not logic and has nothing to do with the real world. No? Well, next slide, please. I did a survey years ago, most of it to finance professor, asking if they used calculated betas and why. No? And those are the answers that I got. Well, I got many more, but those are the principal answers. One is that has received the Nobel Prize in Economics. That, well, if we make a revision of theories that have received the Nobel Prize in Economics, normally instead of saying, well, that this is a proof that they are worth for something, for most of them, is if they get the Nobel Prize, is a proof that they are useless. No? But, well, while not perfect, it is used extensively in practice. This is true. Is used by many people. Other people say that if one does not use the beta, then what is there? That there are no better alternatives. This is not true. A much better alternative is common sense. Valuation is about common sense, no? Common sense. Well, common sense, some practice, and a few items of technical knowledge. No? Better alternative is common sense and experience. No? Is a much better alternative than the capital asset pricing model. The other thing is that this is cited normally by economists. There is a big difference between a true finance professor and economics people that have come to the finance field. That we need another model to substitute. Well, if a model doesn't work, I think that the logical thing is not to use the model and to use common sense. No, we will never get a model about something that has to do with different people, because it's a true beta. There is not a true beta. There is some investors have a beta and perception of risk for a company. Other investors have a different one, and it's a universe of different betas. No? Another say that calculated betas are on the CFA exam. I do not say, and I did not ask why they taught in class the capital asset pricing model. I also teach in class the capital asset pricing model, telling the students that is very used, is used by many people, and that they have to know why it is worthless. No? Another said that the point estimate gives the impression of truth. Well, things like this. Next slide, please. Well, next one, because this the one before, please. No, the next, and next. Yeah, and another. Some professor, I remember a professor that told me also that in his course, his corporate finance course, he devoted 7 sessions to the capital asset pricing model. No, he told me, well, if I say that the capital asset pricing model is worthless, that is what I think, it gives me 1 session. No? What do I do with the other 6 sessions? This was the answer that he told me. Well, next one, please. Then what I have been doing for the last 10 or 12 years is asking people how many, a survey asking people which market risk premium and which risk-free rate they used in the year that for valuation purposes, market risk premium and risk-free rate. And here in this in these graphs are the sum of the two, no? Market risk premium part plus risk-free. And as you can see, there are, as expected, many different opinions. No? Some people and opinions that you can calculate the average, but I don't know if the average is worth for many things. But it goes from in all these countries. I normally get data for more than 10 10 answers for about 40 countries every year, more or less. No? And the dispersion is huge for Spain, and the country I got this year more data was for the USA, then Spain, then Germany, and the UK. No? And the dispersion is huge, and those are numbers that financial analysts, people that works in finance in companies, are normally the people that answers me, or they sell the survey to people in their companies and they send me the data later. Next slide, please. And then with this thing of the expected market risk premium, there are 4 different concepts that many people normally mixes and are completely different. No? One is the historical equity risk premium, that is to see history and to calculate in some years how bigger was the return of the stock market over the return over treasuries or over T-bonds. The historical equity premium is not just a figure, because you can calculate geometrical returns, arithmetic returns. It depends also on the period that you take, but is what has happened, no? And that is interesting to know. If the period is very long, to see what happened to the grandfather, if he invested in the stock market and all that. Another concept is the expected equity premium. That is, what do I expect for the future that the stock market will win on top on investing on T-bonds normally, no? For this, you ask different people and you get different answers. The required equity premium is the one that we plug in the valuation to calculate the required return. No? And is for a diversified portfolio, how much do you think that you should require to a diversified portfolio over the what you can get investing in 10-year bonds or 30-year bonds. That again, this is what I asked in the survey that I showed you before. No? And the implied equity premium is just to make to calculate the internal rate of return of the stock market and the expected cash flows. The question about the expected cash flows is that we don't know which ones they are. Damodaran does an exercise that is the one that approximates more to that, and for the first 2 or 3 years what he puts is the average of expectations of analysts. That, the thing is, some analysts expect big, another one expects smaller. And he can get data for the first 2 or 3 years. No? For the next years, he has to make some assumptions that it would grow at some rate, and the thing is, would be very interesting to calculate the implied equity premium, but the thing is that there are many implied equity premiums because we don't know with certainty what is the required, what is the expected cash flows that that the people have, because different people has different expectations. No? Next one, please. And with this one I will finish. There are some more slides if you want to see later. I also looked at 150 finance, corporate finance and valuation textbooks, and the range in the equity premium went from 3 to 10%. No? Of course, that there also you can see that different professors use different required equity premium, and the books and some books they use different equity risk premium in different pages, no? And it's not that they say that they are talking about something the required equity premium in 2001 and in 2008. Normally this I understand because I have done some books, and you take a chapter from an old book and you forget to change the number, no? And so there is not an accepted equity premium point estimate. And if you go to a web, you will get one for sure, but it will be an opinion among many other opinions. And I think that my time is over, so I finished here. Thank you very much for listening to me.
Thank you very much, Professor Fernandez, for sharing that dialogue. Pratik, Andrew, any questions or conversation you might have? We've got a few questions. Looks like first one from Robert, and forgive me if I'm mispronouncing this, I'll just say Robert. Is there any method you prefer as a substitute for CAPM?
Yes, common sense, which is not a method. Valuation is about common sense, some experience, and a few technical, a few points of technical knowledge, no, and it's a question of common sense. Common sense to to uh, to think about the expected cash flows or different scenarios of cash flows of this company that is in those markets and with this general management, and also for the required return for those cash flows. No?
Pratik has a question. Would you like to launch your camera and mic, Pratik?
Sure. Yeah, so I have one kind of question on this. Uh, while Professor Fernandez, we understand about the the judgmental calls, or you talk about common sense, but when it comes to scrutiny, we have generally seen that if someone is reviewing your valuation, whether it's for litigation purposes or for any standard purposes, in those cases, the auditors or anyone, they rely on CAPM models, or any kind of models which theoretically might not make sense, but at the end of the day, when you are doing it for litigation purposes or any other specific purpose, you still have to rely on that. What would be your take on that particular question?
Well, the thing is that apart from being a professor, I advise to people in M&A activities, and when I advise them in M&A activities, what I try, I do not say which is the right equity market risk premium. The guy that is putting the money is the one that has to say, no, or the guy that is selling. What I do them is questions to reach that figure, the figure that they think that is reasonable, no, either the buyer or the seller. So and and the same with the expected cash flows, no? I know much less than them about their business, and so all the questions that I do is to help them to put figures that sound reasonable to them, no? That they are reasonable to me is
Mhm.
worthless. When I go to trials, I never do evaluation. What I do Well, I did some valuations when I started, but again, as you say, as all auditors and consultants, they come with the capital asset pricing model. What I do now is I always criticize the valuation of others. That is much easier. That is much easier, and normally most of the valuations they have internal consistencies, because well, perhaps from my presentation somebody can say, well, then you can say everything. No, everything, no. Once you put, as people tend to put, a lot of inputs, the risk-free, the formula that they use for calculate for levering and unlevering the beta. They say that they use the capital asset pricing model. Then they use the WACC. The, the normally what I do is to say that the valuation that they are presenting is inconsistent. No? That given the cash flows that they are presenting and the the parameters that they are using, if you do it well, the valuation should give a different figure than the one that they are presenting. No? Yeah, you are right. With the state of the art, if you go there with a valuation that says is my the thing that the number that they feel comfortable is worth for nothing, no? Because other people comes with other number and for judges and arbitrage tribunals, they think that if all the numbers come from a web page, then the valuation is more solid than than if you say that is what you think. And this is true, and as it happens, what I do is I take the valuation, I say, given this and this and that, I show the judge or I show the arbitration, the arbitrator, that the valuation should give a different figure. No? And if they take, especially the market risk premium, if it's not, well, it's not that well, first of all, I don't do all the reports that people require me. I only do the reports if I think that they are right, and especially normally many consultant companies and many investment banks, when they do valuations, they tend to approximate the value to the interest of the client, no? And it's very easy to show the judge that is what they are doing. No?
We have another question for you, Professor Fernandez. What is your take on adjusting CAPM with size premium? Should one do it? For what size classes and based on what data?
No, I don't. I do not make that. One thing is that is true that normally, if you do, if you have portfolio of small companies, normally you get bigger return than in a portfolio of big companies, no? And also almost all the main indexes in the world. Some of them they are already calculating the indexes unweighted, so putting the same amount of money in all the companies. The unweighted indexes normally have a higher return than the weighted indexes. No? So getting more return means that the companies are riskier. I don't know why. Well, this is because people tend to apply the capital asset pricing model, no? And I don't think that I know many small companies that have much smaller risk than much bigger companies, no? Depend on the management, and the fact of being smaller means that it's riskier. I don't see why.
All right, we have one last question as we're wrapping up our time. Would you apply illiquidity premium on top of CAPM for less illiquid stocks based on what data, and how would you estimate the premium?
No, based on data, no. The illiquidity premium, what I do when I calculate is assuming that the company is liquid, and then to say if it's not liquid, then well, of course the shares should be valued less. How much? Well, depending on how much liquidity they have. No, if you have 20% shares of a company that the 80 belong to to your brother or to your brother-in-law, and he's not going to give any dividend until he dies, and he is younger than you, then your shares are very nice to put on your living room and to see them until you die, no? But the value is nothing of that. But it depends. It's not that we can take data from some database and to apply. The thing of valuation is that many people, what they love is what I find also in class, no? This thing of give me a recipe and finish, no? And there are no recipes, no? The professions that can be developed with recipes, the normal salary is about the basic salary, perhaps with a plus if you have to travel, no? But you are doing nothing, and valuation cannot be done with a recipe. It's a question of experience, and well, experience, and also experience. What I tell my students, it's not just a question of being old, or having been involved in many things. It's about having, if you have thought about the things that you have done. If you leave many things and you don't think on them at all, and you are in a hurry, your experience is worth about zero. No?
Well, thank you so much for joining us, Professor Fernandez, and all of you who've joined us for ABW International this time. If you responded to all the poll questions, you will be receiving 1 hour of free CPE. As I mentioned earlier, you'll need to log into your account, whether you're a member or a guest, to access the certificate, and it will be available within the next 7 to 10 business days, 1 hour of free CPE. If you're interested to subscribing to Around the Valuation World, which includes the US and international version, you can do so by following the prompt here in this slide. We also have another Around the next show, thank you, Chinda, will be on February 22nd, featuring Carla Nunez with Duff and Phelps. We have a show in just another hour from now, ABW International, ABW US, it will be 2 hours. And this afternoon's show, this morning's show, will feature several updates, including some on theory and case law and on standards. So you can join us if you're a member, even if you're a guest. Join us on the next version of Around the Valuation World, which will be in about an hour. Again, thank you so much, Professor Fernandez, for joining us this morning. We certainly hope to invite you back. We appreciate you sharing your knowledge with us today and fielding a few questions from our audience. Any parting words?
Thank you very much, Brian, and I have liked it very much talking to you, and greetings from Spain to everybody.
Greetings to Buenos días.
Okay.
Buenas noches.
Buenas tardes.
Buenas tardes.
Okay.
See you later, everyone. And thank you, Pratik and Andrew. Have a good night.